The key themes in 2024, I won't go through them on this. I don't want to take that much time. It comes down to this, a credit crunch. Yellen, Powell both said credit crunch, lower credit wouldn't be the worst thing in terms of consumers. And while that's right, that's like trying to prick a hole in a balloon and let a certain amount of air out and figure that you're not going to pop the balloon or let all the air out or you can plug it back in. All those kinds of analogies apply here. All right. Volcker was very clear to say, we don't want to see a credit crunch. That would be the worst thing. And this is Volcker. In 1978, his first, Humphrey Hawkins testimony, I have shown you the similarity of the words Powell has used to Volcker. We're talking about 2018, 11 white papers, over 300 pages. As you know, I read every word, every page. And it was about the new Fed policy paradigm. We're going to let inflation run. We're not going to have any tolerance bands. In other words, we're going to give you bands. If it gets to 6, we'll do something. No bands, no upside limit. Let it run as far as it wants to. 8-year weighted average would be what they would seek to achieve as a 2%. And since you've been so low for so long, you have to be so high for so long, and this is what the Fed was willing to do. But then the pandemic comes and bashes everything to the upside, and now you kind of got a problem because you don't have tolerance bands, and it took them a long time to get in line with reacting to that, exaggerated move in prices because these things were coming anyway before the pandemic. The pandemic didn't cause them. It just intensified them to the max. In that context, this was really the difference here and now with Powell versus Volcker, the difference here and now with Trump and a revival in the U.S., particularly as it relates to the average guy, and Reagan in the 80s, right after Volcker, defeated inflation in 82, draconian rate hikes, brought the economy down. Now, we haven't seen the economy slip yet, I think in part and parcel because the stock market hasn't slipped yet, and I think the Fed is waiting for some disinflation in asset prices, which they would welcome. So we see it in housing. They want to kind of now see it in equities. But having said all that, the difference now versus 80, 82 is so important because it gets to the entire theme. Reagan and Volcker had no debt. Government, public, consumer, household, corporate, any of it. All right? You are now deluged with debt. You are saturated with debt on every level. The 40-year downtrend in interest rates and inflation over. Debt changes everything. And in this context, as you'll see right here, the call is we're in the debt black hole. And now things are going to intensify again because inflation is going to go back up. All right. What is the debt black hole? Well, I could very simply, define it this way. I think it works, is to look at GDP against the public debt. And when I say public debt, that's government debt, which is our debt. We, the people, own this debt. Not only do we create it, but they sold it back to us and are paying us off in dollars that are devalued in their purchasing power. Hello? But in that context, just pure numbers of public, quote-unquote public debt, not household, not consumer, not corporate debt, just public government debt versus GDP. Nominal numbers, trillion for trillion. Okay? You've been, kind of orbiting the black hole all this time until the crisis, 2008, 2009. What was new? QE. We're now going to print debt, monetize government debt, print money rather, and monetize government debt, which I called in my book in 2006. And of course, if you know the story, Joe Kernan called me a nut job for saying that the Fed would ever do this in 2006 on Squawk Box. And, a year and a half, 18 months later, they were doing it. All right. And in this context, you can kind of see in 2018, with this, bringing on the new protocols, you already kind of got over the event horizon line. What's the event horizon line? It's the line when you enter a black hole. You don't know you've crossed it. You don't know you've entered the black hole, but you cannot escape now. The gravitational pull is so intense. There's no force that you can exhibit or exert, I should say, to get out of the black hole. This is what it is. It's a debt black hole. And I would suggest that you've entered it. You have crossed the event horizon, and for sure, these things accelerated to the max with the pandemic. And now you're here and here. Basically, you went to another way to look at it, just for visuals. All right. That right now, where you are, it takes $1.21 in new debt to generate $1 growth in GDP. All right. Before the crisis in 2008, it was 64 cents, not even. All right. In the last 15 years, this has doubled. I mean, it's flip-flopped and doubled. It was actually a little higher right here at one point at $1.33 in the second quarter of 2020, just to be fair. All right, it is lower now than it was then. It's still higher than at any other time in our history. And when you throw in $18 trillion in household debt, which includes $5 trillion in consumer credit, which includes $1.4 trillion in credit card debt, it takes it to $1.84 to create $1 in GDP growth. We're in the black hole. There's no escape. So what does this mean? Well, it means a lot of things. And first of all, it means the tipping point and the saturation point, the point where this really has an impact on the economy and the markets, is when the consumer rolls over, when the consumer cocoons, when the consumer's choking. All right, you have delinquency rates skyrocketing to levels we haven't seen since 2008 at a faster pace than they rose in 2008, and yet consumer credit has blown out until November. 1 month lagged is the Fed's data on consumer credit. Keep that in mind. Everything else is December. This is November along with trade. Still November data. But a decline, $7.5 billion, all right, that's kind of a rarity. And you can see how much of a rarity it is. It's happened 3 times in the last less than 2 years, which is a rarity. And the only other times it's happened 3 times in that kind of short time period, the pandemic and the global financial crisis. And now.